Hi everyone. Today we are going to discuss CMA Part 1, Chapter 2, another important area that is known as factoring. Factoring is purely related with the receivables of an organization, accounts receivable. In the previous section, we discussed about accounts receivable and allowance for uncollectible account. Receivable is the most important income of any organization because we want to collect the money in time. Otherwise, it will affect the normal operating cycle of the business. That means we have to fund some other way to collect the money, or we have to take the loan to manage the business. The working capital money is required for running a business. So timely we require to fund from the credit sales, that is the receivables. Sometimes, standard companies or some normal companies are selling their receivables to a third party because they don't want to take the burden, credit to follow up, and calling the customers and the payment in time. It will be very difficult for the company for appointing. So this duty they will hand over to the professionals. We can call as debt collection agency. They are the professional agency. They are the professional people for collecting the debt. For their services, we are giving some fee or the collection charges we will pay to them. So these people will handle our receivable departments or our receivables, they will take care of that one. An organization is selling the receivables to a third party is known as factoring. It will reduce the accounting staff. No need to keep accounting department in a receivable because we are selling our receivables. No need people. We can reduce the staff. Whatever the cost incurred for the receivable department can be paid as a charges for these collection agencies or the fees for the collection agencies we can for that. So this is the cost reduction part of the company. Selling its receivables to a third party in consideration of some fee or some collection amount we have to pay to them. Percentage will be there, commission percentage will be there. So an organization is selling the receivables to a third party in order to reduce their burden, in order to reduce their collection difficulties. This is known as factoring of the companies. It is a cost advantage for a company also. So whenever you are selling your receivables to a third party, there will be two types sales you can see. One sale is final, second one is not a final sales. Final sales means without recourse. The receivables completely transferred to the debt collection agency, finish. The receivables are no longer in your books of accounts. This is known as a sales without recourse. A sale with recourse means you are not selling. You are just giving a pledging. At any time you can take back that one. This is the meaning of the factoring. Factoring means selling the receivables to a third party is known as factoring. Look here, factoring, a sale without recourse. A sale without recourse means it is a final sale. Seller has no further liabilities. The selling people have no further liabilities and the receivables no longer in the books of account. You cannot see the receivables in your books of account. Look number 2, sale with recourse might not be qualified as a sales. It is not qualified as a sale. It is a secured borrowings with a pledge. If you want, you can pledge your receivables and take some money. Receivables are still in your books of account. You can see the receivables are still in your books of account. Next topic is inventory. Inventory is a tangible property in the hands of business. We can call as inventory as current asset. In this topic, we are identifying what is the meaning of the inventory, how an organization is keeping for the inventory, what are the methods for the valuation of the inventory. Look here, inventory means tangible property. Inventory means tangible property. Inventory may be held for sale. The inventory will be held for sale. And you can see sometimes in the form of work in progress. Sometimes inventory is in the work in progress. That means work started and but not completed. That is also a part of inventory. Then some inventory you are used in production. That is also an inventory. So inventory means inventory held for sale in the form of work in progress and used in the form of production. We know that inventories are current assets. Inventory does not include long-term asset subject to depreciation. And the cost of inventory means what? How you are calculating the cost of the inventory? The total cost incurred for purchase of the inventory. That is the total or the all cost incurred for the inventory in our factory is known as the total cost of the inventory. Cost of manufactured inventory means what? Sometimes we are calling manufactured inventory. Cost of manufactured inventory. Cost of manufactured inventory means what? Work in progress and finished goods will be there. There is work in progress and finished goods together we can call as cost of manufactured inventory. In inventory valuation or inventory counting, we have two methods are there. One is perpetual inventory system and the second one is periodic inventory system. Perpetual inventory system means update inventory at each purchase. Whenever you are purchasing, you will update the inventory. Normally, small items, higher value items will be jewelry. Normally, they are preparing which perpetual inventory system. Every time they will update the cost of goods sold and inventory. This is a Herculean task for because bookkeeping is a lengthy process there and it is an expensive system also. But some organizations are following periodic system. 3 months, 6 months, 1 year they are doing the periodic inventory and the cost of goods are updated in the specific interval 6 months or 1 year is known as periodic inventory. So perpetual inventory system is there and a periodic inventory system is there. When inventory is the transfer from one place to another place, that may be goods in transit. It's on the way. How you are calculating whose inventory is this one? There is two shipping points are there. One is FOB, free on board. Free on board means legal title passed to the buyer when the seller delivers the goods to the carrier. Okay, whenever we are sending the goods to the carrier, the shipping point, this is known as FOB. Then up to that point, the goods will be handed over to the third person. FOB destination means you have the goods should be reached up to the destination point of the buyer. Then only it will become the goods of that third person. Up to that point, the goods will be the seller's hand. So 2 points are there, FOB and FOB destination. Free on board means shipping point, then the goods will be, all the title will be transferred. Second point, FOB destination means you have to transfer the goods or reach the goods at the destination point of the buyer. Up to that time, the goods will be the seller's hand. This is the FOB and FOB destination. Next, we can discuss about cost flow method of inventory counting. In order to counting of the inventory or in order to find out inventory valuation, there is some cost flow method is there. Number one is specific identification method. This is one of the first method in the inventory counting. Determines which specific items are sold because in your hand many loads are available. From these loads you can identify, okay, rupees value 5, that item you are selling or you are used for the production purposes. Specifically identified items you can use for the production purpose. That method is known as specific identification method. Which material, quantity, value will be used for production. Specifically, you can identify a particular quantity of material and you can take for the production purpose. This method is known as specific identification method. Number two, moving average method. There should be an average price will be there. 5, 6, 7, 8 rupees are there, dollars are there. Average price. Whenever each purchase you are making, one more price is coming. Therefore, the average will be changed. That method is known as moving average. Moving average determines new weighted average cost after each purchase. Whenever the new purchase will be coming, the average will change. Another purchase will be coming, average will be changed. That is the moving average. And third one is weighted average method. Most of the companies are following weighted average method. Weighted average means total cost of the goods divided by total quantity. You will get an average price. That is known as weighted average cost of the year end. We will check what will be the weighted cost. Apply all of them used for production. Another two method is FIFO method and LIFO method. FIFO method means the material coming first are introduced for production first. That is known as first in first out method. FIFO method. First in first out. The material came first will be issued for production. There is another method is there, LIFO method. Last in first out method. Last in first out means material came last will be used for production. That is known as LIFO method. So both methods are important. FIFO method is important and LIFO method is important. FIFO, the material coming first will be introduced to production. That means latest will be there. So whenever a company is using LIFO method and FIFO method, the important point is to be note that FIFO method always the material came first will be used for production. Therefore, the latest purchase will be there. If the material price are high, if the material prices are high, or the material prices are increasing, if a company is using FIFO method, they are using the old material. Therefore, its cost will be reduced and ending inventory will be increased. Notable point number 1, the material prices are increasing. What will be the effect in the cost of goods sold and ending inventory in the case of FIFO method? Under FIFO method, the material cost is increasing. The cost of goods sold will be less value and the ending inventory will be more value. What is the reason behind that one? FIFO method, first in first out method we are using. Material coming first only used for production. First will be old price. Therefore, the cost will be reduced. But latest purchase will be included in the ending inventory. Therefore, the ending inventory value will be higher there. That is the important points to be noted there when a company is using FIFO method. Opposite, we can say LIFO method is there. What will happen? Opposite situation. If a company is using LIFO method, the material prices are increasing. The cost will be increased and ending inventory will be decreased. This is situation of FIFO and LIFO method. These are the important accounting methods of the inventory. Next, the subsequent measurement of inventory depends upon cost method used. How we will value the inventory on the subsequent method. That is why subsequent measurement of inventory always depends upon the cost method. The subsequent inventory valuation will always depends upon the cost method. The inventory accounting is using LIFO or retail inventory method. Normally we are using LIFO method and retail inventory method is measured at the lower cost or market price. We can apply lower cost or market price. Lower cost of market price is known as LCM. Lower cost or market is known as LCM method. Under LCM method says that market means what? The current replacement cost of an inventory. Market means current replacement cost of an inventory subject to limitations. You want to replace the inventory, but there is limitation is there. Point number 1. Market should not exceed NRV. This NRV valuation is known as ceiling. NRV value is known as ceiling value of the material. NRV is equal to selling price minus cost of completion expenses. Selling price minus cost of completion expense. This is known as ceiling amount for the inventory. But it should not be less than NRV minus normal profit. While fixing the inventory value, the market means what? The current replacement cost of an inventory is known as market. But market should not be greater than NRV and not less than NRV minus normal profit. 2 points are there. Current replacement cost of an inventory should not exceed the ceiling value and floor value. Ceiling is known as NRV and floor value is known as NRV minus normal profit. And current replacement cost must not be greater than NRV or less than NRV minus normal profit. So, whenever you are finding out the value of inventory, sometimes value will be higher in the market, sometimes value will be less than the market. In order to adjust it, you can use which method? This method is known as LCM, lower of cost or market method. Lower of cost to market method says that market is the current cost to replace the inventory. But market should not be exceed the ceiling value and floor value. Ceiling value means NRV minus what? The cost of completion. NRV minus normal profit, that is the floor value. So it should not be exceed and it should not be less than. In the mid value should be coming. This is known as the LCM method, lower of cost or market method. Inventory accounted for using any other method. In the previously we discussed one FIFO method, sorry, LIFO method. Now any other cost method means FIFO and average method also there. Here you can apply for lower of cost or NRV method. Inventory should be measured lower of cost or NRV method, you can apply that one. But under IFRS says that all inventory is measured at a lower cost or NRV. All inventory is measured at a lower cost or NRV method. Reversal of write down of inventory is prohibited. Reversal of write down of inventory is prohibited in the financial statement at the end of the period. But under IFRS is that if you want, you can reversal is possible, or the write back or write down may be reversed, but not in the original cost. So important point here will be, here inventory accounted for using any other method include FIFO method and average method. We can apply which one? Lower cost or NRV method. We can apply lower cost or NRV. IFRS says that all inventory should be measured at a lower cost or NRV. Lower of cost or NRV method, you can apply that one. Reversal of write down of inventory in the financial statement is prohibited as per GAAP. But IFRS says that it can be applied or it can be reversed, but not in the original cost. Sometimes while recording the inventory, the value of the inventory will be overstated or understated. This is known as inventory errors. Number one, overstatement of ending inventory. Overstatement of ending inventory means your ending closing stock value will be showing more amount. What will be the effect in the financial statement of a company? Number one, your ending inventory is overstated. Your gross profit will be more, your net profit will be more, your working capital will be more, your cash flow will change, your equity will change, your net income will change. It will affect n number of places in the current year. If closing inventory is more, it will affect n number of places. GP is increasing, net profit is increasing, equity is changing, cash flow is changing, working capital is changing. Every places its effect in the current year. So what will be the effect in the next year ending inventory? Current year we already discussed that everywhere increase is no monitoring. But in the next year or the second year, ending inventory is increasing, GP will be less, net profit will be less, then working capital will be less. Everywhere opposite reaction will come due to the overstatement of the ending inventory. Then we can come the next point. The overstatement of opening inventory will be what happened in the current year. Current year, our gross profit will be less, net profit will be less, our net income will be less, our working capital will be less, cash flow will be less, everywhere less will come. But in the next year, it will be opposite. GP will increase, net profit will increase, equity will increase, every places you can increase that one.